The Landmark Cars Limited Q1 FY27 earnings conference call hosted by Axis Capital Limited. The lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the management's opening remarks. Should you need assistance during the conference call, please signal the operator by pressing star, then 0 on your touch-tone telephone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantee of future performance of the company, and it may involve risks and uncertainties that are difficult to predict. I will now hand the conference over to Mr. Vijay Pandey from Axis Capital Limited. Thank you, and over to you.
Thank you, Ryan. Good morning, everyone. Welcome to the Q1 FY27 post-result conference call of Landmark Cars. We are pleased to host the promoter and management team of Landmark Cars today. We have with us Mr. Sanjay Thakkar, promoter, chairman, and executive director of the company, Mr. Aryaman Thakkar, the executive director, and Mr. Surendra Agarwal, the CFO of the company. I'll now hand over the call to Mr. Sanjay Thakkar for his opening remarks. Over to you, sir.
Thank you, Vijay. Good morning to everyone. On behalf of the company, I extend a warm welcome to everyone who has joined us today. On this call, as Vijay just said, I have Aryaman and Surendra Agarwal who have joined me. The results and the presentations are uploaded on the stock exchanges and the company's website. I hope everybody has had a chance to look at it. Financial year 27 started on a strong note, with pro forma revenue from operations growing at over 22% year-on-year to deliver our best ever Q1 performance in a seasonally soft quarter. Profit after tax nearly doubled, ahead of the revenue growth. This financial performance was driven by improving operating leverage and sustained cost discipline, and reflects the continued scaling of the business. Moving to the automotive industry, the sector continues to evolve, supported by healthy customer demand and broader choice of powertrains. Electric mobility traction increased significantly in recent times amidst geopolitical situations, and EV adoption is emerging as an important structural change and a trend. We are happy to report that 30% of the vehicles sold by value have been EVs at Landmark, much higher than the industry. Landmark has expanded its capacity and partnered with relevant brands over the last few years, enabling us to participate meaningfully in the growth that is happening. Sticking to the EV story, there have been questions about the after-sales revenue potential that the EVs would generate over time. The initial study indicates that there is absolutely no negative impact on after-sales revenue from EVs as compared to ICE vehicles. This augurs well for the annuity type of after-sales business that we have built over the years. Please refer to the slide number 8 in our presentation. We have found that the EVs run much more on the road as compared to ICE vehicles due to its lower cost of running. This increases the frequency of its visit for periodic maintenances and accident repairs to our workshops. On top of this, the accident repairs for EVs cost more than ICE vehicles, as has been seen across the globe. This is ensuring higher revenue per vehicle for the full year for EVs currently. One should also note that due to the sophisticated technology, the EVs will come to the authorized workshops more often than the ICE counterparts. And this, incidentally, is a finding similar to what I was reading in the commentary by Penske, one of the leading American automotive retailer, where they also found a similar trend happening in America. The EV segment also presents a new and differentiated revenue opportunities. As part of our strategy to build a comprehensive EV ecosystem for our customers, we have signed an MOU with ChargeZone, one of India's leading EV charging networks. Under this partnership, our EV customers will receive wallet credit redeemable at ChargeZone's charging locations, while we will earn a share of charging revenue from onboarded customers. This is an industry-first partnership between retailer and a charging service provider, and it allows us to create an additional recurring revenue stream while deepening the engagement with EV customers well beyond the point of sale. Over the last few years, Landmark has added many new brands in its portfolio. Its margins as well as cost structures may be different than our existing brands. The after-sales business of these brands also is in a ramp-up stage, so we believe that the way to look at our business may be better at EBITDA and PAT level, along with cash profit from business rather than the gross profit level. Looking ahead, we expect the demand environment to be positive. The corresponding period last year saw some lumpiness in the quarterly trend influenced by GST-related changes, deferred purchases and subsequent pent-up demand. While these dynamics are largely behind us, we expect a more normalized and consistent demand trajectory through the later part of the year. And with this, I'll hand it over to Aryaman to take us through his points.
Thank you. The beginning of this year has seen a strong momentum across the private vehicle car market. Due to various macro factors and post the GST cuts, we have seen that the premium and mass segments have grown faster than the luxury segment over the last few months. Let me now provide some color on the performance of our individual OEM partnerships and key developments across our network. Starting with Mercedes-Benz, the brand continues to be the leading luxury brand in India, recording a sale of 9,786 units in H1 calendar year 2026, which was a 9% year-on-year increase. It is working on its biggest ever product offensive with over 40 new models expected to launch globally starting from 2027. The focus on its top-end vehicles is paying off as the demand for it remains strong. We have seen this reflecting in our average selling price, which has increased to approximately 79 lakh rupees in Q1 FY27, which is up from 73 lakh rupees in Q4 FY26. The increasing penetration of electric vehicles has positively impacted MG Motors. They are the second largest EV OEM. The new MG Magister also commenced deliveries during the last quarter, strengthening the premium portfolio. More models are expected to be launched shortly across EV and hybrid powertrains. A new SUV, which is to be launched later this month in August, and we expect that to significantly boost volumes. We recently received an LOI for an additional MG showroom in Ahmedabad, which will take our total MG network to 17 outlets and further strengthen our presence with the brand. Mahindra continues its strong momentum. The new launches have been very well received, with more launches to follow later this year. Our new workshop for Mahindra will be starting operations soon in Hyderabad to cater to the strong after-sales momentum we are witnessing. BYD continues to perform well. the supplies for BYD will significantly improve throughout the rest of the year. The hybrid models will also be launching later in this financial year. Our outlets in Pune have become operational in July and will further increase our market share with the brand. The luxury brand of BYD, Denza, is going to be launching in India shortly. Kia continues its healthy momentum post the launch of the new Seltos, which has received a great response. The recently launched Syros EV has also received very healthy order bookings across India. The new Sorento is expected to be launched in September, and we expect the brand to continue its good performance throughout the year. Honda has shown encouraging improvements, supported by the City, the Amaze, and the Elevate. The launch of the City facelift and the ZR-V further strengthens its presence across the sedan and the premium SUV segments. The Alpha Zero electric SUV will launch later this year, which will be the right timing given the broader switch to EVs. The commercial vehicle market continues to remain strong, and we are seeing that in the performance of our Ashok Leyland dealerships. We are awaiting details of the recent media reports of a potential deal between the JSW Group and Volkswagen India. On the after-sales front, we have reached our historic growth phase. We are selectively expanding service facilities to increase capacities. Today, we are inaugurating a large 50,000 square foot workshop in Mumbai to cater to Mercedes-Benz, BYD, and Jeep. If you refer to our investor presentation, you can see that we have a large upside possibility in after-sales for our new high-growth brands. From outlet perspective, we continue to expand in markets where we find attractive potential while maintaining capital discipline. Overall, our diversified OEM portfolio across luxury, premium, and EV segments, combined with our showroom and workshop network, positions us well to capture the structural growth opportunity in organized auto retail. I will now open up the call for questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Arnav Sakhuja from Ambit Capital. Please go ahead.
Hi, thank you for taking my questions. So my first question is that there were a few news articles which mentioned that some OEMs like Mercedes has been taking a few price hikes in the last few months. So can we see some improvement in the Mercedes gross margins because of these price hikes, or were the price hikes mainly just to cover the increased costs of the cars?
So Mercedes-Benz, along with most of the OEs that we represent and those who we do not, have taken a price hike because of the raw material prices going up globally. So what happens is that we get a percentage of that hiked amount. So the margins per se in percentage would not increase, in absolute number will increase.
Got it. And there was also a few articles mentioning that Audi India is getting increasingly aggressive through some new model launches, and they plan on their aim is to increase their market share from the current levels of 8% to around 16%. So, do we expect that there could be any pressure on Mercedes sales because of this, or would they likely capture the market share from other OEMs?
I think it's high time that the luxury market itself, and what we have seen is that new offerings many a times actually expands the market, the addressable market. The luxury market, as you may recall, has been kind of hovering around 50,000 units, and the penetration of luxury to the overall market has actually in the last year reduced, which is contrary to everybody's belief. What Ariman just mentioned, that the premium as well as the mass market has grown faster this year than the luxury market. And it's time that luxury market catches up. That's how we have seen the trend fanning out over the last several years. So competition is welcome. They generally expand the market. It's not that we will play only in this 50,000. It's a matter of time when that 50 will become 60, just like the passenger car market, which from 4 million will reach 5 million this year, is what everybody expects. And of course, Mercedes-Benz is having their own new models which are going to be launched in the next few quarters.
Got it. Congrats again on the strong results, and thank you for answering my questions.
Thank you.
Yeah. We take the next question from the line of Akhil from 360 ONE Capital. Please go ahead.
Thanks for the opportunity and many congratulations on a very good set of numbers and also good disclosures in PPT. And also, as Sanjay sir has said multiple times in past, right, this business is fairly predictable if followed a very disciplined approach. I think we have kind of showcased that now over last a few years as our profitability is inching upwards basically. So the first question from my end is just from 2 to 3 year perspective, how should one look at it given that we are generating now strong cash. Last year also, if you look at it, we generated almost 250 to 60 crore of operating cash flow, and this quarter also almost 60 crore of operating cash flows. So are there any white spaces which we may tap into, maybe probably the OEM additions or further outlet or workshop additions, which can help us to sustain this growth momentum for next couple of years at least?
Yeah, Akhil, what you are saying and what you have observed is the absolutely correct thing. The business generates a decent amount of cash. We had increased our dividend payout also last year meaningfully. Now we continue to be in lookout for opportunities across OEMs, across the ecosystem, where we can actually deploy money and make it meaningful. So yes, we are in talks with some OEs who may be entering India, some who may want to expand, some maybe a takeover opportunity, but we don't want to rush into it. We will do it on our terms. So the had gone through a very rapid amount of expansion and what I sometimes call a blood transfusion into our system to have a different fiber of what a landmark was and what it is today. And that ship has stabilized. The metrics are coming back to where they belong. And the opportunities are all there. And we will take it one by one.
Sure, that's good to hear, sir. So second, on the new vehicle sales business, right? I mean, we have been there handsomely, and our margins, which had dipped there to almost 1.7% in FY25, has been steadily on upward trend. Like FY26, if I look at it, moved to 2%, and now at 2.3%. So what would be some of the levers for the further margin improvement, basically in the new vehicle sales business? That's my second question.
Yeah. So in new vehicle sales, as you know, is a combination of what the market operating price is. The price hikes also help for a one-time kind of a thing. The demand basically being more than the supply or as much as the supply actually helps the situation where you don't need to give out any kind of freebies to the customers. So this is something which is a trajectory that we are seeing, and I'm pretty hopeful that this will continue to kind of go on the upward trajectory. It is also a factor of target achievements, and I'm hoping that, and I'm feeling that our target achievements for one or the other brands will also improve. So this trajectory should continue.
Sure, great to hear that. And that brings me to my last question. So from an overall profitability perspective, is it fair to assume that somewhere in FY28 we should be handsomely crossing the profits which we did in our peak cycle of FY23? That's my last question.
I wish I could say this in a VUCA world that we are all living in. We are on a trajectory which is going to take us there. We'll let the world kind of hold its the way it is and not have some shocks.
Okay, sure, sir. Thank you so much, and I'll get back in queue for any further questions. Thank you.
Thanks, Akhil.
Thank you. We take the next question from the line of Bhargav Buddhadev from Ambit Asset Management. Please go ahead.
Yeah, good morning to you.
I'm sorry to interrupt you there, but your audio is not clear. Could you please use your handset and proceed with your question?
Yeah, handset only. Is it clear?
Slightly better, Bhargav.
Yeah. We have about 141 outlets, and if we divide that into showrooms and workshops, we have 77 showrooms and 64 workshops. Now that we have opened a lot of showrooms in the last 2 years, is it fair to assume that over the next 2-3 years, the mix of showroom and workshop can be 50-50? Because effectively the ROC in workshops is much higher, and now that we have enough showroom penetration, the focus incrementally will be on workshops. You also highlighted the opening of a Mumbai 55,000 square feet showroom workshop. So just wanted to know your thoughts on that front.
Yeah. So Bhargav, let me kind of explain to you the number of workshops. The workshop could be of different shapes and sizes. We have workshops which is 5,000 square feet, and we have workshop which is 1 lakh square feet. So one workshop is not kind of comparable to the other. So the number of workshops may not be the best way to look at situation. What Aryaman just mentioned, that we are opening a workshop in Jogeshwari today, 50,000 square feet. Actually, we'll house 3 brands over there. And what we will do is that we will give up, once this is operational, some workshops which are smaller workshops and consolidate it in a one workshop. So on paper, you may see that the number of workshops has possibly reduced or remained the same, but we have added significant amount of capacity in that consolidated place where the margins would be better, our control would be better, and operating costs will come down over there. So, but what you are saying, and I hear you, and this is exactly what is happening. We are adding workshop capacity. It may not be looked at from the number of workshop basis, but the number of bays basis. So like in Mahindra and Mahindra, we have seen that our capacity has already got exhausted in Hyderabad in no time. And in say Mahindra and Mahindra, our contribution of after sales to the overall revenue is single digit even now, where the group group is mid-teens. So once we add this capacity, the Mahindra after sales business will continue and contribute much more. Same thing is with Kia, where we have added workshops. In MG, we are adding more workshops. In BYD, where we are selling hundreds of vehicles now a month. which we did not think was happening. So we are desperately going to be adding more BYD workshop capacity. We have seen that the EVs actually are a good revenue stream for after sales. So the workshop capacity will, yes, come up much more, but it may not be seen in the number of workshops, but the number of bays. Let me see if we, over a period of time, can our disclosures have always been kind of looking at and hearing investor voices and the questions, because we are defining the segment. So whether we can actually give you the number of bays that we have rather than the number of workshops.
Yeah, no, that makes sense. Sir, my second question is that if you look at your new high-growing brands, the share of EV within that is much, much higher. And if you look at your after-sales contribution from these high-growing brands to your overall after-sales is 19% versus 38% in new car sales.
Exactly.
In your PPT, you have mentioned that the EV service revenue is much higher, given the higher frequency and also the coverage in terms of kilometers. Yeah. So, is it fair to assume that, given the higher contribution of EV, this after-sales contribution will also grow much, much faster, and possibly it will match your new car sales mix maybe sooner rather than later?
I'm hoping. So it's a factor, Bhargav, of a variety of things. One is capacity. In case of, like, say, a BYD or Mahindra, we need more capacity, which we are adding. It is what we have given on page 8 is the per car revenue. But we need, in some brands, we need more cars. So right. So once both things happen, the number of cars, and which is going to happen sooner rather than later, and the critical mass and the capacity being reached, this will reach. And you have rightly caught, and that's why we have kind of said that the upside in after sales for these brands is significant.
And service EV in the normal service center, or you need a separate service center for
same service center with some different equipment. And once our Jogeshwari workshop is fully operational, we are inaugurating the Mercedes part of it today. You will read it in the newspapers. After 2 hours, I'll be cutting the ribbon over there. You'll see it in the press and all that. But once the BYD and the Jeep part is also completed in the next few months, we will invite investors to have a look at this state-of-the-art workshop.
Right. I don't know. All the very best.
Thanks, Bhargav.
Thank you. We take the next question from the line of Dheeraj Kasan from InCred Equities. Please go ahead.
Congratulations, Sanjay sir, on a great set of results. And I just wanted to first talk about the service mix that has been, it has been lowering, but that's because we have been experiencing a very high kind of growth the past 6-7 quarters in the new car sales. But as we are seeing that you have posted that the new vehicles that we have added, they have contributing 38% in our new car sales, but only 19% in the after sales service. So I think we are expecting that maybe from FY28 onwards or mid FY28 onwards, we will be seeing a major kind of growth coming from there. As also right now, the volume growth from 14% of after sales, we have only experienced 4.8% volume growth, whether everything is coming from value growth. So I think most of our outlets are still very underutilized in terms of service center, correct?
So yes, you have kind of read this situation well. The upside in after sales for the brands which are in the 19% bracket is clearly much more. And yes, our sales growth has been far outstripping the service growth. But it doesn't say that the service growth is lower. Service growth is at 14-15%, which has been our historic growth. So service is growing the way it should, but we are selling much more. That's why it's a question of this mix which is happening. But selling more is always good. One should look at the absolute number of money one makes rather than only the margin.
Yes, and also our margins have been like quite better in the past 2 to 3 quarters in the after-sales segment. So is this a structural shift, like from above, we are going above 18%, and we have been maintaining that?
We are
At any point?
I think it would hover around. Many a times in some of the quarters, like March or December, we also get annual bonuses, which are not accounted in the first or the second quarter of the financial year. So that also plays up the thing, and as what we have disclosed, as a kind of a revenue from charging. Now, who would have thought that we would be able to open up a new segment in itself which did not exist at all. So this, we believe, will also help us slowly, gradually, and it's going to be pure profit from the commission from the charging that people will do.
Okay. Yeah, so just last question, can you explain kind of in in unit economics how this new partnership is going to help us, if we sell we are selling 30% of EVs, we are selling 25,000 cars a year, so selling almost 7,000 8,000 vehicles, how much units does a car usually consume, and what kind of revenue share are we looking at from this segment?
Yeah, I don't want to do it on a public forum right now or to disclose the commercials over here because it's a unique, first of its kind thing, and we want to kind of keep it exclusive before somebody else tries to copy it.
Sure, so we can connect afterwards for this. Thank you so much.
Yeah.
Thank you. We take the next question from the line of Lokesh Manik from Vallum Capital. Please go ahead.
Yes, good morning, Sanjay sir and Ariman and team. Am I audible?
Yes, Lokesh, go ahead, please.
Yeah.
How are you? Yeah.
Great. I'm good, Sanjay sir. Thank you. Sir, my question, just continuing on the charge zone, I appreciate that you cannot disclose details, but some color on, whether it would conflict with the OEMs because they would also want to put up their charging zones and they have their battery specifications, all those kinds of nuances, or it also helps you, from an OEM perspective, you become a preferred dealer in a lot of areas because you are offering that charging zone which is coming through this partnership. So how should we look at this? Some idea on that, broad idea would be really helpful.
Yeah, Lokesh, Aryaman here. I'll be happy to share some details. The charge zone, just a quick background on them. I think they operate close to 16,000 charging points across India. They are already working with most of the major OEMs in this space, including the mass market brands, the premium brands, and many of the luxury brands. Of all shapes and sizes. What we are doing is that we will be, it will not really be a conflict with any of the OEM. I think the idea is that Landmark will actually onboard our EV customers onto their charging network, which is already operational. We are not putting up additional charging capacity with them. We are onboarding customers to their charging network, which is already existing and approved for charging across OEMs.
Okay. Understood.
Yeah. And the idea is that and we will be kind of getting a revenue share of those customers' spend, which will be a recurring basis over multi-years.
Got it.
And the customers will also benefit because they will be getting a certain amount of wallet credit, which they can redeem while utilizing the charge zone network. So it also, in a way, an additional benefit is that it also helps us converting more customers on the sales side by utilizing this tool.
Correct. Great. My second question was on after sales. So, I don't need exact numbers, but if you can just give us an idea, what is the space for utilization left, where we can reach reasonable utilization levels, and how far are we, let's say from 100, are we at 50, 60, 70 utilization? Just some broad idea on that would be really helpful to get a sense of the potential for after sales in the portfolio.
Lokesh, it is location-wise and it is brand-wise. It's a little difficult for me to off the cuff rattle out a number. And also, please keep and bear in mind that Landmark is one of the few who has made this entire asset allocation fungible. So what is happening is that wherever we see, and that's why we go deep in a geography. We not only go deep in a brand, but we go deep in a geography. So in case of a downturn or a lesser capacity that a certain brand would require either at a showroom level or the workshop level, it is quickly given to some other brand. So before we add up more capacity, we always look at utilizing the existing capacity wherever we can actually do. We have cut our workshops, we have kind of reshaped, resized our workshops as well as showrooms to kind of do this activity.
Great, sir. That's it from my side. Thank you so much and all the best.
Yeah, Lokesh.
Thank you. Participants who wish to ask a question, please press star and 1. We take the next question from the line of Vijay Pandey from Axis Capital Limited. Please go ahead.
Hi, sir. Thank you for taking my question. Sir, a couple of questions. First on the outlet side. So, our number of outlets is around 144. So, how many? I remember that last time when we spoke, there were around 8 outlets that were you classified as new. So, just want to understand how many of these 144 are still are new, and there the ramp up can be on a higher side over coming quarters, and how many of them have moved to the nominal level, like with more than 12 months of operation.
Yeah. So, Vijay, we stopped kind of taking refuge under this new category. We said that now there are no meaningful number of new outlets. So we don't want that handicap or some consideration from investors that these are new outlets. And we are putting everything under one bucket now. Because the nature of the business is that we will continue to have 2, 3, 4, 5 new outlets at any given time. So that's fine. That's the way we have always been. That's the way the business is. So we are not we stopped classifying any kind of new outlets. I think a couple of quarters back. After that, we have kind of taken everything as if it's regular old.
So, as of now, is it fair to assume that almost all of them are broadly all of them are operating at nominal capacity? Or?
No, that's not what I'm saying. There will be some which are not operating at the optimal capacity, but we are not kind of trying to carve them out. Whatever has opened, say 3 months back, 6 months back, we opened two new outlets of BYD only say a week or 10 days back in Pune. Now, obviously, they are not working at optimal capacity in the first 15 days of operation. So there will be outlets like these which will continue to be new, but that's the part of the journey. So there will be a few which will be like that.
And sir, on the profitability side, so is it fair to assume that because last year I remember that we had some GST related issues in the second quarter. So should we assume that this year quarter 2 and going forward quarter 3 and 4 will be a more normalized quarter with like an EBITDA margin of 1.5% on pro forma? On new car sales?
Yeah, it would be a normalized quarter. I do not expect any disruption like what we seen in this second quarter. Last year, second quarter was a traumatic period, and I don't expect that to repeat.
And sir, on the Mercedes side, the quarter on quarter, the revenue has declined meaningfully for Mercedes-Benz. So, any particular reason, or what should?
See, look at the business in a seasonality way. The first two quarters of the financial year are 40% of the business, and the last two quarters are 60% of the business. We all know that the Jan-Feb-March quarter, not only for Mercedes-Benz but for everybody, is bigger than the April-May-June quarter, which is the slowest quarter in the Indian automotive industry. So the message here is that if on the slowest quarter this kind of growth has happened, though let me qualify that last year the base was lower, and after September or October of last year, the Indian auto industry, after the GST 2.0, started to grow at a much higher, a faster pace. So the 2 points here which I am making is that there is a seasonality. March quarter is always bigger than June quarter, and we have grown with Mercedes-Benz year on year by a big number.
Okay. And sir, anything on the interest cost? How should we expect over coming quarters or coming period?
Yeah, so the borrowing costs for us are pretty stable. We haven't seen anybody asking for a higher rate. Our cash generation is happening month on month, and our capex, which we had guided in the last year closing at around 50 crores. We are as of now in line. The first quarter we have spent less than the proportionate share. I can't say for the rest of the year so far, but as of now we are holding that, and that cash generation is going to repay the working capital loans till we need the money.
Okay, sir. Thank you. I'll fall back in the queue.
Thank you. We take the next question from the line of Harsh Shah from Helios Capital. Please go ahead.
Hello. Yeah, am I audible?
Yeah. Yes, Harsh, go ahead, please.
Yeah, congratulations on a good set of numbers, and again, very good set of disclosures, especially on the aftermarket sales side. Now, I understand that in the after-sales service business, in the EV side, the sales are much higher, up by 45% in brand 1 and 9% in brand 2. However, can you talk about the quality of these sales, like what sort of profitability margins will there be here? Because I'm assuming in EVs, there'll be a lot of electrical, electronic sort of component changes, which might be in the material cost side and might not have very high margins.
Can you, Harsh, repeat this? I didn't exactly understand what you are asking.
Basically, sir, I'm asking when we look at the revenue on the after-sales side, EV versus ICE,
Yes.
I understand that it is higher.
Yes.
Can you also talk about the profitability on this higher revenue? Is it similar to what we are making right now at around 18% margins on EV?
Yeah, it is. What we have excluded from this, if we had not excluded the warranty, then the number was in fact looking much more in favor of, not in favor, I mean favor is an incorrect word, where the EV cost was looking much higher if we had taken the warranty. The warranty may involve changing of battery, which would be a very high value thing. So we have taken of now what you are seeing will be similar.
Okay.
So we are not saying that it is going to be higher over a period of time. We are trying to say that it is not going to be lower. Right now it shows to be higher, but we are taking a cautious stand because the things are just kind of unfolding, but we don't expect it in the near term to be lower.
Okay, got it. This is. Thank you.
Yeah.
Thank you. We take the next question from the line of Chirag from MS Capital. Please go ahead.
Hi, congratulations on a strong set of numbers, sir, and thank you for the opportunity. Just one clarification. I think in the opening remarks, Sanjay, you mentioned that gross margin is probably not the right way to think about our business in the interim. Could you just elaborate on that? Obviously, gross margins have been a little soft also this quarter. Could you help us understand, what are the moving parts in gross margins that make it misleading on a quarter-on-quarter basis?
Yeah, Chirag. So this is something which we don't, while we do the business, we don't look at it so closely. Now, when we started looking at it closely, what came out is that every brand has its own kind of a business model, where there are higher margins that we may be able to make. The costs are also higher. Operating costs are higher. The manpower requirement, the quality, the infrastructure is different. So the net, what comes out of it, so this is one part. And the second is that the mix of sales and after sales. So A business will have 16% after sales as a component of its overall revenue. Business B, which is starting now, may have 5 or 7% after sales business, which will give a gross profit which is lower for business B. But the business B may also have costs which are lower prescribed by the OE. So it's a little complex thing. It is between sales and is going towards, because why do we need a gross profit? We are basically finally wanting an EBITDA and a PAT and the cash that the business generates. That is the objective of doing it. So that's why we make this submission. And in maybe a one-to-one meeting, we can show you on a spreadsheet as to how why we are saying what we are saying.
Understood, sir. I'll follow up.
Yeah.
Thank you. We take the next question from the line of Abhisar Jain from Monarch AIF. Please go ahead.
Yeah, hi, sir. Sir, my question is on the employee cost and other expenses. We have done very well there, and I think we are now trending below our earlier stated targets. So as we ramp up from here in terms of the sales, since the new OEMs sales volumes are ramping up, what do you see these numbers trending going ahead, and is there room for more efficiency in these two metrics?
Yeah, Abhisar bhai, thanks for this question, and I believe that on this call are some of our senior employees who have also joined. So from my side, from our side on this table, that the cost focus has, and we believe that go down as the revenue increases, that it will. The point is with the newer launches, a lot of availability and ASP going up, the revenue is going to grow. We have to keep a razor focus on the costs, and we believe that this still, as a percentage, has a way to go down.
Sir, any indication on what could be efficiency over the next 2 years? If you assume a certain growth in top line, which of course we are right now having a little higher growth with the industry doing well, but even at a much more normalized top line growth, what would you expect these metrics to further improve by, if any indication?
I would take a little more time, maybe once on a separate call or whatever. We will try to do a more detailed, granular number rather than my just throwing a number. What we have done, Abhisar bhai, and you will appreciate, is that whatever we have walked the talk. When we said 4% of cost, and we went there, we actually did that. A certain thing will happen. We want to be a credible organization. What we say is what we do. So please allow us some time to put a number. I'm only saying that the numbers, can the cost still go down? Yes, they can.
Sure. Understood. And so just one request on the gross profit front. Is it possible to share the breakup of the gross profit quarter-wise in your PPT for after sales and new car sales, so that we at least get the trend and understand that there sometimes are fluctuations because of the OEM mix in every quarter which impacts it. If it is possible, I would urge you guys to discuss.
I'll Abhisar bhai take this back with me. We will see what we can do.
Okay. Sure, understood. And so just the last thing, as you mentioned that with cash flows, being robust and capex being on the lower side, at least for now. Of course, next year you will have your own plans sorted out, but for now the capex is also lower. So the excess cash flow will keep on reducing the debt and subsequent decrease in the finance cost. Is that understanding right?
It is right.
Understood, sir. Thank you so much and best of luck, sir.
Thank you, Abhisar bhai. Yep.
Thank you. We take the next question from the line of Akhil from 360 ONE Capital. Please go ahead.
Yeah, my question is answered already. It was on debt and interest also. Thank you so much.
Thank you. We take the next question from the line of Raman KV from Sequent Investments. Please go ahead.
Hello, sir. Can you hear me?
Yes, Raman.
So, I just have two questions. One, during this quarter, we grew, our top line grew around 22 to 23%, roughly. How much was this because, what percent, on a ballpark figure basis, how much was because of the increase in average price, because the OEM took price hike, and how much was volume?
I think the price would be maybe around 3%. I'm just giving a ballpark. I don't have it offhand, but I'm just saying the rest was because of the volume.
So on 19% will be the volume.
Yeah, I would think so. I may stand corrected going ahead, but I don't think I'll be that way off.
Okay. And so second question is, how much was the lease or rental cost for this quarter?
How much will what?
How much was the lease and rental cost for the quarter?
Yeah, I think let's have Surendra. We haven't heard his voice in today's call. He didn't give an opening statement, so let's have him. He's also here.
So our lease cost, which is the amortization of lease, is around 19 crore for the quarter. If we look at the lease and interest lease cost is put together is 27 crore. So roughly around 25 crore is our rental cost. So there is an India's impact on the lease is around 2. You can see.
So going forward, yes. Hello, can you hear me?
Yes.
So going forward for the entire year, our rental costs or like including the adjustment will be around 110 CR.
Yeah, 100 crore around. Yeah.
Okay, understood. And so my last question is, internally, what's your target of converting EBITDA to CFO? Is there any particular target?
So, if you look at our EBITDA percentage is 5.8%, which is roughly same to the last 2 years. We are maintaining that percentage. We see further improvement percentage.
No. I was actually, I just want to understand whether there is any internal target of EBITDA to CFO conversion, cash flow conversion.
Okay. So cash flow last year it was 0.95%. We will be around that only.
Okay, understood, sir. Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for their closing comments.
Yeah, thank you, Axis Capital and the participants for a positive and a productive earning call. As we, GFT 2.0 has given a fillip to the industry and the demand side remains to be robust. Having added the capacity in the times which were tough, Landmark is well poised to capitalize on this and reward every stakeholder in its journey. Thank you.
Thank you. On behalf of Access Capital Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.